What's going on, guys? Bexio back, and today we got a brand new video with the CPI data dropping and being worse than expected. As per usual, what is this, like the ninth month in a row of it being worse than expected? But before we get into all of that, if you're not subscribed, make sure you smash that sub button because we're on the road to 1,000 subs. But let's look at this CPI numbers right here because they are not looking too great. You can see right here is the overall, which is 7.5% inflation year over year. It is worse than expected, and I mean, obviously, this is not great, not a good thing to happen. And we saw reactions in things like Bitcoin and even the stock market on this news because obviously big inflation means the rate hikes might be worse than expected, and then the inflation means, more interest in Bitcoin as an inflation hedge, as people have pushed that narrative. So but the interesting thing about all of these inflation things is actually this chart's right here saying, obviously talking about trying to explain how this could be possible. And all you got to do is look at this chart, which is in this Bureau of Labor thing. They have this chart in here, but you can see energy, 27% is the energy inflation. The prices have gone up 27%. And they say all major categories, so this is where they get the CPI from, is up 7.5%. So if we just do some really quick math here and say we know energy is 27, we'll say food is 7, and all items less food and energy is also 7, and we take just the average of those three bars, we get 13.7%, which is almost double what the CPI says it is. So just how do we get 7.5% with a category that has a big weighing in the CPI is up 27%? How is not possible? That would bring the average up so hard. So I mean, come on. You have one bar up 27%. The average can't be close to these two when we have one that's just a massive outlier here. And we can see month to month inflation too. So we see since October, basically a drop here. Not much of a drop, but from 0.9 to 0.7, and now holding 0.6. If you bring 0.6 out for a year, it's 7.2% inflation. So even if we hold 0.6 inflation, we'll have another year of over 7% inflation, which is still ridiculous. And we see even in the middle here, so June to October, we saw a drop down, and then it came roaring right back. So even if this is the drop down now and it roars back, we're going to be getting into full percentages month over month, which is going to be a little crazy. And you can see some of the things that they break down in here. The biggest things that changed are things like food at home is actually up more than food away from home, which doesn't make much sense. You would think food at home is cheaper, but apparently not. And then we have fuel, oil, energy services. That's what we already know. Electricity, 4.2. That is, so energy is really pushing things up here. And then obviously we still know is the used cars and trucks are still 1.5. They're still going up, still in the higher end. So cars still pushing the sector up, energy still pushing everything up, food even still going higher. It's almost at the all-time highs. You can see is at 1.0. The high here is 1.2. So still going up relatively a lot. We can see your Bitcoin kind of doing what it always does on CPI day. A lot of a sell-off here and then an explosion when the data came out, and we're actually selling off yet again. So it's weird that every single CPI day where the data comes out, every time there's a run up and it comes right back down. It'll come back down to 43.3. It always does the same thing, and it's crazy that it does it. I mean, we break hovering 44, but we'll probably come down to 43.225 just because that's where it took off from. And it's crazy that that's even happening. And you see the stock market, lots and lots of red with the data coming out with fears of the rate hike being worse than expected or higher than expected because the inflation data came out much worse than expected. And then on the topic of Bitcoin and inflation, a big thing to look at with Bitcoin is something like this, where you can see the annual salary and the average house price. You see explosion in house price. This is in the UK. I don't know why it's UK, but it's the same for anywhere. So an explosion in house price, and the salary is basically just a small little straight line going up. So inflation, it makes you feel like you're doing all right, that you're getting raises, that you're getting like 2% raises a year, maybe 3-4% if you're lucky. And then you feel like you're doing good, you feel like you're making more money, when in reality everything is getting more expensive, everything costs more. So you making more money doesn't actually equal out. You're actually probably making less money, especially over these last couple of years, where if you were in if you got a raise of less than 7.5%, then you are losing money that you're working for. You're getting paid less today than you were last year if you didn't get a raise of at least what inflation is. So this is talking about Bitcoin and how Bitcoin can solve this, and it's a pretty easy indicator. We have the Big Mac index from Bitcoin here. So what you can see, Big Mac, so green line is the price of Big Mac. So you can see it's on a steady upcline. You know, we've got some increase in price here. The green line, the blue line is the price of Bitcoin, and then the red line is if you priced Big Macs in Bitcoin, how much it would cost in Bitcoin to buy that. So where you see the price exploding, but the cost of the Big Mac dropping and plummeting. That is the idea of Bitcoin, where it's monetary policy, you know it all. It doesn't overtake or screw over people who are saving, who are not investing money doing this kind of stuff. It doesn't devalue what's already there. So that's the whole idea here. And with the dollars, the fiat system, you can see you have the steady increase in salary, but an explosion in asset prices. We have the opposite. We can have an explosion in the price of Bitcoin, but a plummet in the cost of goods to buy with Bitcoin. And that's the difference here. So things get cheaper over time. Even though the price of Bitcoin can go up a ton over time, the price of goods priced in Bitcoin goes down because there isn't a devaluing of Bitcoin that's already out there. We know the cap. You can't just create more and inflate prices and deflate wages, essentially. And finally, we just have a little chart here from Lynn Alden talking about, you know, the 7.5% inflation. And it is the biggest gap over short-term interest rates since 1951. So obviously, if you held cash or treasury bills, you lost over 7% of your purchasing power. People think cash in the bank is good. It's not great if you're losing 7% of your purchasing power. You're losing money even though the number doesn't go down. But you can see the massive gap. 0.08% is the funds rate, and just 7.5%. I mean, massive gap stuff. You are losing lots of purchasing power if you're not getting returns over 7.5% for the year, or having some way of making more money, 7.5% raise for the year or something. So inflation, pretty bad. We all were kind of expecting that, except for, I guess, the Fed wasn't expecting inflation to be bad. It beat their expectations, worse than expected. And obviously the market not really liking it, and Bitcoin having its normal reaction of running up and then running right back down. So we'll see what happens over, you know, the next couple of weeks with this stuff, and the Fed's meeting coming up in March, I believe, to see what they actually end up doing with the rates. That's gonna do it for this video. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. See you in my next video.